Last Tuesday, while financial media tracked stock indices and crypto volatility, a 47-page technical document appeared on the Bank for International Settlements website. The title, Unified Ledger Implementation Framework, Phase 3 Interoperability Standards. Effective date, March 15, 2026. To most readers, it's regulatory white noise. To central banking insiders, it's the infrastructure blueprint for the largest monetary transition since Bretton Woods. Here's what you need to understand immediately. We've passed the debate phase on central bank digital currencies. The European Central Bank has already run live pilot programs in 5 member states. The Federal Reserve's FedNow system processed over $80 billion in the final quarter of 2025. The Bank of England published a 200-page consultation on the digital pound in September. The question is no longer whether CBDCs are coming. The question is, what happens to your bank account when the old rails get replaced? For a century, cash in your wallet represented final settlement. Anonymous, sovereign, unrestricted. The March 15th mandate represents the technical migration away from that model. By the end of this investigation, you'll understand why major financial institutions are implementing transaction metadata layers, what programmable money actually means for spending autonomy, and the specific structural changes happening to deposit accounts across Western economies. This isn't speculative futurism. This is regulatory infrastructure already moving through implementation timelines. Let's examine the evidence. To understand why central banks are executing this transition now, you need to see the mathematical corner they've backed themselves into. Start with the sovereign debt crisis. According to the Institute of International Finance, global debt reached $315 trillion by the end of 2025. That's 340% of global GDP. The United States alone carries $35 trillion in federal debt, with net interest payments consuming 18% of federal revenue according to the Congressional Budget Office. The UK's Office for Budget Responsibility projects debt servicing costs will hit $120 billion annually by 2028. Germany, historically the fiscal disciplinarian of Europe, now runs a debt-to-GDP ratio above 70%. Here's the critical insight. In a traditional banking system with physical cash as an exit option, governments face hard constraints. Citizens can withdraw deposits. Capital can flee to harder assets. Central banks lose control during confidence crises. The historical parallel is instructive. In 1933, Executive Order 6102 required U.S. citizens to surrender gold holdings above $100 to the Federal Reserve. The official justification was economic stabilization during the Depression. The practical effect was removing a competing store of value that citizens could use to exit dollar devaluation. The modern equivalent doesn't require confiscation. It requires migration to a ledger where the rules of money itself can be rewritten in real time. Between March and August of 2026, the global banking system completes its transition to ISO 2022 messaging standards. This isn't a currency change, it's a protocol upgrade. ISO 2022 allows banks to attach rich data to every transaction: origin, destination, purpose, compliance flags, and policy conditions. Once money carries embedded metadata, it becomes programmable. And once programmable, it's no longer a neutral medium of exchange. It's a conditional voucher subject to policy enforcement at the point of transaction. Let me show you the technical architecture that makes this possible. In a traditional payment system, transaction approval is binary. You have sufficient funds, or you don't. The transaction clears, or it fails. The Federal Reserve's FedNow system and the ECB's digital euro pilot programs introduce a fundamentally different model, the policy engine. Here's how it works. When you attempt a transaction in a CBDC environment, your payment doesn't just check your balance. It passes through a compliance layer that evaluates multiple conditions before settlement. The Bank of England's February 2025 discussion paper, New Forms of Digital Money, explicitly discusses programmable functionality. They present use cases including restricting purchases that exceed environmental limits or preventing transactions deemed harmful to public health. The European Central Bank's digital euro prototype, tested in pilot programs across France, Spain, and the Netherlands, demonstrated a feature called conditional payments. These are transactions that only settle if predefined criteria are met: location, time of day, merchant category, or cumulative spending thresholds. I want to be precise here. I'm not describing a dystopian hypothetical. I'm describing technical specifications from publicly available central bank documents. MasterCard, in partnership with several central banks, has developed what they call a multi-CBDC platform that links digital currency accounts to digital identity systems. The technical documentation describes integration points between payment ledgers and government databases, tax records, social services, regulatory compliance systems. BlackRock's Aladdin technology platform, which manages over $21 trillion in assets, has developed risk management tools specifically designed for CBDC environments. These tools allow financial institutions to implement what they call dynamic balance restrictions during periods of market stress. Translation: if the system determines there's a bank run risk, withdrawal limits can be automatically adjusted, not by human decision, by algorithm. The March 15th technical mandate establishes the interoperability standards that allow these systems to communicate across borders. A digital euro account needs to be able to transact with a digital pound account, which needs to interface with FedNow. That requires unified protocols, and those protocols include the policy engine architecture I just described. Now let's examine how this transition is being structured in the three largest Western economies. In the United States, the Federal Reserve has been publicly cautious about CBDCs while simultaneously building the infrastructure. FedNow launched in July 2023 as an instant payment system. It's currently optional, but the Fed's technical roadmap, obtained through Freedom of Information Act requests by several financial research groups, shows planned integration with digital dollar prototypes by late 2026. The incentive structure is straightforward. The U.S. Treasury has discussed tax credits and rebates for early adopters of digital dollar accounts. Think of it as a $500 to $1,000 incentive to migrate your deposits to the new system. For many households, that's compelling. In the UK, the Bank of England and Treasury published a consultation in February 2023 on the digital pound. The official timeline shows a decision on implementation by 2025, with potential launch by 2028. The consultation explicitly states that the digital pound would coexist with cash, but it would become the preferred method for government payments, benefits, and tax refunds. Here's what matters. Once government payments flow exclusively through digital accounts, citizens face a choice. Maintain two systems, one for government interaction, one for private banking, or consolidate into the more convenient digital system. Behavioral economics predicts the outcome. Convenience wins. Germany presents a more complex case. The Bundesbank has historically been skeptical of rapid monetary innovation, a legacy of hyperinflation trauma. But as an EU member, Germany is bound by ECB decisions. The digital euro, once implemented, becomes mandatory infrastructure across all Eurozone nations. The German Finance Ministry has indicated that commercial banks will be required to offer digital euro accounts by 2027. Not optional. Required. Let me walk through three plausible scenarios for how programmable money affects your wealth over the next 3 to 5 years. Scenario 1. The incentivized migration. This is the soft launch. Between now and late 2026, governments offer carrots, tax incentives, lower transaction fees, instant settlement, enhanced fraud protection. The digital euro account or digital dollar account is presented as an upgrade, not a replacement. Most people migrate voluntarily. Your wealth remains accessible, but it now lives on a ledger with terms of service. Those terms include clauses about compliance with evolving regulations. You can spend freely until a new policy is implemented. In this scenario, physical cash remains legal, but becomes increasingly impractical. Fewer merchants accept it. ATMs become scarce. The infrastructure is dismantled through disuse, not by force. Scenario 2. The crisis trigger. This is the more likely accelerant. In 2027, a mid-sized regional bank faces a liquidity crisis. Maybe it's a European bank overexposed to commercial real estate. Maybe it's a U.S. bank caught in a rapid interest rate environment. The government steps in, but not with a traditional bailout. Instead, they announce an emergency migration. Deposits in troubled institutions are frozen for protection, then transferred to CBDC accounts guaranteed by the central bank. This is the modern bail-in, but executed through digital infrastructure. Your money doesn't disappear. It just moves to a ledger you don't control. The IMF has discussed this model in multiple reports, calling it a resolution mechanism that protects depositors while preserving financial stability. The catch: the new account comes with the full policy engine, transaction limits, spending categories, expiration timelines if the government wants to force economic stimulus. Scenario 3, the inflation emergency. This is the worst case, though not implausible given debt levels. If inflation spikes again, say to 8% or 10%, central banks face a dilemma. Traditional tools like interest rate hikes cause recession, but a CBDC offers a new option: programmable expiration. To force spending and prevent hoarding, the central bank could implement time-limited currency. Your digital dollars or euros must be spent within 90 days, or they lose value. Not through inflation, through literal expiration coded into the ledger. This isn't theoretical. The People's Bank of China tested expiration features in digital yuan trials during 2020 and 2021. The ECB's Digital Euro research team has discussed demurrage features, negative interest rates applied directly to CBDC balances to discourage saving. The logic is economic stimulus. The reality is the destruction of savings as a concept. Now, let's look at what informed institutional investors are doing. According to data from the World Gold Council, central banks purchased over 1,000 metric tons of gold in 2024 and again in 2025. China, Russia, Poland, Singapore, all aggressively accumulating physical bullion. Why? Because gold sits outside the digital ledger system. Private wealth management firms serving ultra-high net worth clients report a significant shift in asset allocation. Conversations with advisors at firms like UBS, Julius Baer, and Pictet reveal clients moving 20% to 30% of liquid wealth into hard assets: real estate, precious metals, fine art, and decentralized digital assets. The pattern is clear. Sophisticated capital is reducing exposure to bank deposit risk. Family offices in the US and Europe are increasingly using multi-jurisdictional structures, holding accounts in Switzerland, Singapore, and the UAE, jurisdictions with stronger property rights and less aggressive CBDC implementation timelines. This isn't tax evasion. It's jurisdictional diversification. The crypto market, despite volatility, has seen institutional accumulation of decentralized assets, particularly Bitcoin, which operates on a ledger without policy engine architecture. Whether you view this as a viable alternative or speculative gambling, the capital flow is real. Blackstone, KKR, and other private equity giants are deploying record amounts into real assets, infrastructure, logistics, energy. Assets that generate cash flow outside the banking system. The informed aren't waiting for confirmation. They're repositioning now, while the migration is still optional. First, audit your ledger risk. How much of your net worth sits in a single bank account? In a CBDC transition scenario, that's your maximum exposure. If your bank announces a migration to a new digital platform, your ability to decline may be limited. Diversification becomes critical, not just across asset classes, but across ledger types. Some wealth in traditional banks, some in physical assets outside the banking system, some in decentralized systems that don't require central intermediaries. Second, watch the digital identity rollouts. In the European Union, the digital identity wallet is being implemented across member states. In the UK, the One Login system is consolidating access to government services. These systems are the authentication layer for CBDC accounts. The moment your bank requires digital ID verification to access your account, the integration is complete. Your financial activity is now linked to your government identity profile. Third, reduce unsecured debt tied to major commercial banks. In a programmable money environment, debt is leverage, not for you, but over you. If you owe money to an institution that can restrict your transaction capacity, your negotiating position deteriorates. This isn't about paranoia, it's about understanding the risk architecture of the emerging system. Finally, stay informed on regulatory timelines. The Bank for International Settlements, the IMF, and your national central bank all publish implementation roadmaps. The information is public. The March 15th mandate I mentioned at the start is real. BIS document reference, CPMI 2025-03, available on their website. Read the technical specifications. Understand the policy engine architecture. Know what conditions can be placed on your money before you're forced to accept them. Here's what the timeline looks like based on current regulatory momentum. Between March and December 2026, ISO 2022 becomes the global standard for financial messaging. That's the protocol layer that enables CBDC interoperability. It's not optional for banks. It's a compliance requirement from the Bank for International Settlements. By mid-2027, the European Central Bank is expected to make a formal decision on digital euro implementation. If approved, Eurozone banks will have 18 to 24 months to integrate the infrastructure. That puts full rollout in the 2028 to 2029 window. The Federal Reserve is more cautious publicly, but infrastructure development continues. If the U.S. experiences a significant financial stress event, a bank failure, a sovereign debt crisis, a payment system disruption, the timeline accelerates dramatically. The UK will likely move in parallel with the EU, given trade integration and financial system dependencies. What does this mean for your personal financial sovereignty? If you're in the US, UK, or Europe, you have roughly 18 to 36 months before CBDC infrastructure becomes the default rails for the majority of transactions. Physical cash will remain legal in most jurisdictions, but infrastructure support will erode. Merchants will deprioritize it. Banks will make it inconvenient. The strategy isn't to fight the system. It's to ensure you're not entirely dependent on it. Hold assets across multiple ledger types. Maintain accounts in multiple jurisdictions if feasible. Reduce exposure to unsecured bank deposits beyond insured limits. Build relationships with financial institutions in jurisdictions with stronger property rights. This isn't doomsday prepping. It's prudent risk management in a system undergoing structural transformation. Let me be direct about what I'm not saying. I'm not claiming central banks are engaged in a conspiracy to steal your wealth. I'm saying they're executing a policy transition designed to increase monetary control and reduce systemic risk from their perspective. Whether that aligns with your personal financial sovereignty is a question you have to answer for yourself. What I am saying is this: the transition to programmable money is not speculative. It's documented in central bank white papers, technical specifications, and implementation timelines. The BIS, the ECB, the Bank of England, and the Federal Reserve have all published extensive research on CBDC architecture. The policy engine, the mechanism that allows conditions to be placed on transactions, is not a fringe theory. It's a design feature discussed openly in regulatory consultations. Your advantage is information. Most people won't understand this transition until it's mandatory. You're seeing it now while it's still voluntary. The March 15th mandate is a technical milestone. It's not the day the trap snaps shut, but it's the day the infrastructure becomes fully operational. The next 18 months are the window. Use it. Subscribe to this channel if you want detailed breakdowns as each phase rolls out. I'll be tracking regulatory filings, central bank announcements, and institutional capital flows. Because in the emerging financial system, the only people who maintain autonomy are the ones who saw the architecture before it became mandatory. The information is public. The timeline is known. The choice is yours.